everyone, and welcome back to the premium video newsletter for September 10th, 2013. Lots to discuss today, and most of what's occurring is still surrounding Syria. The job openings and labor turnaround report was released earlier this morning, showing overall hiring levels as well as job openings, layoffs, and quits. This report is similar to the labor report we get on Fridays, but it's more detailed. The latest data on job openings and turnover in the workplace reaffirms the painfully slow but steady progress taking place over the past 3 years. The economy is adding jobs, but much of the improvement has come from a drop in layoffs and not rapid hiring. The big news was released last night after the closing, when a diplomatic solution seemed at hand, after Syria said it had accepted a deal pushed by Russia and based on comments by U.S. Secretary of State John Kerry to put its chemical weapons under international control for their later dismantling. I mentioned during the last few days that the Nasdaq market was completely ignoring Syria, and yesterday before the announcement came, the broad market was doing the same. Overall, the U.S. is far less reactive to an attack than it was just 1 week ago. If this psychology continues, we should see some volatility to the downside over the next few days in commodity prices. If you recall, I mentioned last week that if Syria doesn't develop, the two markets that are going to be hit the most are the metals and the oil markets, since they have the most direct exposure to Syria. The precious metals sold off sharply today, as it looks like the United States will not attack Syria. The gold market rallied over the last 2 weeks from the 1350 level to the 1430 level and back down. The question now remains is what's the next step for the gold market? If U.S. does not attack Syria, we will see continued retracements. Many buyers who purchased gold thinking war is coming will begin unloading their positions, and that may drive gold below the 1350 level and somewhere near the 1300 level. I think we will see this in the next few days, especially if we start hearing less talk of war, which seems to be the case today. The next market we want to look at is the crude market, which is also extremely sensitive to what's happening in Syria. The crude market is slightly in a different category than the gold market because right now there is potentially increasing global demand from Europe and China, and this may help maintain higher prices. However, with that said, I still believe the market is right now trading off of Syria almost 100%. And if we hear less and less news that war is coming and more news about a peaceful resolution, the market will continue to lose steam. My current short-term target is the 104 to 103 level. I would need to see how we're trading at these levels and if more weakness is coming into the market at these levels. Let's see how the news interprets Syria over the next few days before we rush to judgment. For now, expect more selling pressure till we hear something from Obama regarding moving forward with a plan to attack. But for now, I'm not seeing it, and either is the crude oil market. The U.S. stock market continued to rally as we anticipated yesterday. The rally was broad-based, and now the broad market is in fact once again in a bullish phase. We were under the 50-day moving average for about 1 month or so, and today we filled the gap that started this breakdown. This is a bullish indication, and if we continue to hear positive news in regards to Syria, the broad market should be hitting the 1690 to 1700 level by the end of the week. The RSI indicator that measures overbought and oversold levels is just above 65 right now, and we won't get overbought till we hit the 75 to 80 level, so there's plenty of room there, especially in light of the fact that we went nowhere for the last month. One thing that's giving me pause is historically, September is not a good month for the stock market, and although we may rally, I'm still rather doubtful that we will break out to a new high as of right now. Let's see how the market reacts if and when we hit the 1700 level. Although I'm bullish for now, I'm still skeptical that the broad market will hit an all-time high during this swing. So let's keep an eye on the 1700 level carefully. Two markets that I'm watching very carefully and that are also extremely sensitive to each other is the bond market and the US dollar market. I've already explained, but I want to make sure you understand that right now, the stimuli program is causing many large investors and funds to decide whether or not they want to keep their money in US currencies. And this is largely dependent on the interest rate yield they will get for keeping their money in the dollar. If interest rates move higher, the dollar will rally and foreign currencies will sell off. And if the interest rates don't move higher, traders will take money out of the dollar and invest in foreign currencies. Since the Feds are only weeks away from making their decisions, these two markets are extremely correlated to each other, more so than usual. In essence, the world currency markets are tied to US interest rates very heavily. Today, we saw very little trading action in bonds as well as the dollar, and that was not a coincidence. Technically, the bond market broke yesterday's low, but only by a few ticks. If Syria improves and no war comes our way, the Feds will continue with cutting the stimuli as planned, and that will increase rates. And this is where this market is heading right now. It's not totally sure, but each day that passes and we don't see us attacking Syria puts us on a greater course to increase rates sooner than later. I'm short right now, and the only way I will consider turning my position around is if we attack Syria and Feds tell us that they're not cutting the stimuli anytime soon. I doubt either of these two scenarios will happen. So I'm still going to stay bearish till they do and if they do. Let's talk about the setups for tomorrow. There's a good looking 4x4 to the upside on Tesla Motors. Ticker symbol is TSLA, and you should place a buy stop at the 167.75 level. And if filled, place a protective sell stop at the 160.30 level. We need to give this setup a bit more room because of the strong volatility this stock produces. The profit target is near the 180 level, so there's a good profit to loss ratio on this setup. The next setup is a sell on IBM, which I'm sure you've heard of before. Place an entry sell order at the 186 level on a stop, and if filled, place a buy stop at the 188 level. Also note, I'm bullish on the broad market, but I'm still skeptical we're going to make new highs on the broad market, the S&P 500. IBM is a very strongly influential stock, and the fact that it's moving down substantially is not making me feel warm and fuzzy about the broad market in the near term. I don't feel this way about the NASDAQ market, but remember, the broad market is much bigger, and it's much easier for it to push NASDAQ down than for NASDAQ to push the broad market up. That's it for today's tutorial. I will update you midday tomorrow, and have a great night, everyone.